Well, thank you, everyone, for having me. I think what I'm going to do is just go over a 25-minute presentation, and then I'd open it up to questions. I'd encourage you to hit me with as difficult questions as you can so that we can make the session engaging. So I'm just going to share my screen now. Do you see my screen well?
Yes.
Okay, great. So the topic of the presentation, I thought what would be most useful is what I would have liked to hear when I was a 20-year-old. And so essentially, the topic is searching for the world's greatest businesses at extraordinary prices. So I think I'll start with a story. This is about 10 years ago. I wrote I was working at Goldman Sachs. I was working 100 hours a week in investment banking and tech media telecom. It sounded like a great post MBA job. I sort of very quickly came to regret it, given the 100-hour week. So, anyways, I left Goldman, and I decided to kind of just manage my own money. And I came across this Japanese company. Which was trading at low prices. And it was quite an interesting company. It was a 125-year-old business. It seemed to have a wide moat. And so I kind of wrote up this idea and sent it to Warren Buffett. And this slide here shows his response to his assistant saying, Sid, it's a good company. We're looking for companies like this that we can buy control of on a friendly basis. Keep your eyes open. So essentially, I'd suggested to Mr. Buffett to buy the company because it met his criteria. Fast forward 9 years later, you'll see sort of in August 2013 when I sent the letter to 9 years later, and just a point to note, past performance is not indicative of future performance. This is certainly not a recommendation of a stock or business. But it is for a case study for educational purposes for this group. The stock has outperformed all the Asian indices, including the Japanese index, which is most relevant comparable, but it's also outperformed the S&P and Dow. Now, this isn't local currencies, but I assume, an investor could hedge the Japanese yen. But in any case, the performance, it quadrupled at its high. Now, what was it about the business that I liked, that I feel Mr. Buffett liked as well? The first point here, this is excerpts from the filings of the company. This slide illustrates the company's strategy, which is a big fish in a small pond. So what Kobayashi does is it goes after small ponds, but it becomes a big fish in that small pond, capturing about 50% market share, where there's very limited competition. Now, what enables the reinvestment opportunity, and reinvestment essentially is growth opportunity for this company to keep doing this over and over and over again, is that the company has this open culture, which I'll go through in the next couple of slides. But this was something that caught my attention because of the reinvestment opportunity in niche products. I would encourage you to read the annual reports, say 2014 or so. Those were the ones that 2013, that's what I read when I sent Mr. Buffett the idea. The second point I note, and there were many points, but I'm just highlighting 3 points. The second point here is this is directly from the company's filings. This is the ROIC, return on invested capital framework, a tree. So they've created a ROIC tree and conduct management, which is focused on profitability and capital efficiency, essentially incentivizing middle management based on this concept called return on invested capital and understanding the drivers. Now, it's important to note that the return on capital for this company was, well in excess of 35–40%. But keep in mind, Japan's cost of capital is extremely low. So what you should focus on is the value creation between return on capital versus cost of capital. That's what matters. Now, it's also important to note that the company had increased profits and dividends consecutively for over 20 years. At the time I sent the write-up. Part of what got my attention was that sales had declined significantly, but margins were going up and cash flow was going up. And when I dug deeper, the reason for that was the company was divesting its asset-intensive businesses, so cash conversion was going up and returns on capital were going up, etc. Um, the third key point here that I noted was that the company is an idea company. Essentially, junior employees, mid-management, mid-level employees are incentivized to come up with ideas and propose ideas for new products that they themselves would want to see in the market, but they don't exist. So, for example, this is this cartoon that talks about the Netsusama sheet, and I'm sure Shinya would be very familiar with this product. But when I went to Japan, and I've been to Japan many times, if you go to one of the drugstores, you'll see hundreds of Kobayashi products, or at least 75 or so. But many of these products are not sold in Asia, certainly not in India, certainly not in China, maybe only 10. So there was a large reinvestment opportunity if the company was just more aggressive in terms of marketing outside of Japan. Anyways, this slide focuses on the idea culture where junior employees can uh, discuss or present their ideas every month in front of senior management. And that is, as you know, rare anywhere, but it's very rare in Japan. Now we'll just go over some ingredients of great businesses. Now, I just spent like half a day just collecting some of these filings, and certainly this is not exhaustive, but I hope this gives you a sense for some of the things that I look for. So this is Coca-Cola's annual report in 1987, the year that Mr. Buffett purchased, a stake in Coke. Put in, I think, about $1 billion. I might have the numbers wrong, but like about $1 billion, which essentially is worth now, say, 25 billion. I haven't looked at the recent Choraria report, but this is from the 1987 report. And you could see that the company was saying that we serve 524 million times a day and counting. The net income, the returns on equity, unlevered tangible equity, which is what Mr. Buffett focuses on, is 27.2%. I would argue that this is underreported, and it's probably as high as 40%. But anytime you start getting a company where it's 35, 40, 25%, and cost of capital is, say, call it 10%, that's good. Now, the question is, Coke was obviously very early in its global growth strategy, which is what Mr. Buffett identified. Their volumes were also, as you can see from the top right, double that of our nearest competitor. So this is just from the 1987 annual report. I have a second slide on Coke. They were aggressively repurchasing their shares. Over a 3-year period, they repurchased 10% of outstanding shares. This is typically a quality I look for, and it's certainly a quality Mr. Buffett looks for. For example, on Apple. The bottom left shows the cash flow statement of Coca-Cola from 1987. The company, as you can see, grew operating cash flow from 693 million to 740 million to 1.2 billion. So operating cash flow is growing, something that I do look for. And then on the right, this is again from the annual report of Coke. It shows their understanding of what value creation is. And this might seem like a fairly simple chart, but it's important to understand what the value drivers of company are. Here you have a reinvestment rate of return of capital, which should exceed cost of capital, which generates cash flow as the company grows. And then, that ultimately leads to shareholder value, again, in a very simple way. This slide is American Express in 1964, which is when Mr. Buffett again bought, a stake in American Express. It's been his longest investment to date, about 5 decades, if I'm not mistaken. At the time, it was a wonderful business trading at an extraordinary price due to the salad oil scandal. Prior to the crisis, as you can note here, the company's net income in 1964 had jumped about 20%. It had paid 95 consecutive years of dividend payments. So before Mr. Buffett, actually got involved with Amex, it had already paid 95 years of dividends. They had already had their largest dollar volume sales increase in their 73-year history before he, as he was getting involved. And then the filing at the very bottom is about some of the claims against a subsidiary, which is the warehousing company, which had some liabilities related to the solid oil scandal, which Mr. Buffett, obviously estimated that the liabilities were going to be well covered by sort of the balance sheet and the brand of American Express. The next report is Nike. This is their first annual report from 1981. As you can see on the left, on the top right, there's just an excerpt I pulled out from the filing, which talks about John McEnroe's court-played Wimbledon, Carl Lewis's 28-foot-long jump. And the reason why I put this there is Nike it could be a commodity, a shoe company, but it's more than that. It's a brand. They honor great athletes, and that's what Nike stands for. And this is what Steve Jobs, in one of his iconic YouTube, I think videos which you can watch on YouTube, talks about Nike has brilliant marketing strategy. It's a great product, but it's a shoe company, right? But they honor great athletes, and I think that is, that's really the secret sauce. And now they do make great products, and the companies. This is financials from 1981. The company's revenue growth, as you could see, is almost up 70-80% from 269 million to 457 million. Currently, Nike's sales are over 45 billion. Just FYI, they started off as a $2 million revenue business, of course, back in the 1970s. But as you can see, high growth, high returns on equity. They had limited debt and had figured out a strategy to while being a commodity shoe company, to have a brilliant marketing strategy. This is just the annual report from Costco, which is, I'm a loyal customer at Costco in the US. They delight customers by generating high sales volume, rapid turnover at very low prices, while growing their membership base, right? Very loyal membership base. Since 1991, Costco has grown operating cash from 380 million in 1991 to 7.4 billion in 2022. The excerpt on the top left is the membership, and this is a very key part of the moat of Costco, because they essentially earn very high gross margins on their membership. And I would argue that Amazon Prime sort of copied Costco. Jeff Bezos sort of learned from Costco, but as you can see, Costco's kept its moat, and its stock price sort of reflects that. The hot dog, which is $1.50, the price has not changed. Even though inflation. So this is cheaper than your masala chai shinya that you had today. Today the price has not changed, right? And the operating cash flow.
It's actually Singapore dollars, so it's a little slight. It's probably the same price.
Yeah, probably the same price, but it's not changed. You get the point. The cash flow of the company back in 2000 was 1 billion operating cash flow, right? So as you can see, there's a familiar pattern in all of these company filings that I sort of look for. This is Infosys. This is Infosys, which is a remarkable Indian company. This is a 1999 annual report. Now, they had stated very clearly in the 1995 annual report they want to be a global company, and the way to do that is to focus on creating this talent pool that they should empower and incentivize. And you'll see this on the bottom right, awards for excellence from 1999 to 2000. Here are employees that were being profiled on the front page of the annual report, of Infosys annual report. This is not the founder and the managing director, but employees, mid-level employees being featured in the front page of the annual report, which is rare, by the way. I haven't come across this sort of recognition given, and by that year, 1999, there were already $270 equivalent millionaires, in Infosys in India, which is a big deal because India, it's still a emerging market. But back in 1999, there weren't that many there weren't that many millionaires, and so as you can see, the growth of the company on the top left grew revenue 80%, returns, net margins were 31%, high returns on equity. They were incentivizing employees, and of course they benefited significantly from kind of the tailwind of the internet and the outshot, but just a very interesting company. This is TSMC in Taiwan. This is a 2005 annual report, which talks about with the single on the top left, you have, with the single exception of 1997, we have achieved positive free cash flow every year since our IPO in 1994, when trough utilization rates have improved with. So essentially, a great business must be able to defy, survive, and grow amidst a crisis. And TSMC, as the table on the right can demonstrates, has had a history of growth and a history of actually cash generation through cycles, while maintaining extremely high market share in their pure play semiconductor foundry segment. Members of this club would have noted that Berkshire recently became a shareholder of TSMC. I don't believe it's Mr. Buffett himself, but probably one of the two deputies. But nevertheless, you see from the filings in 2005, we're talking about looking at some of the qualities, 17 years ago, already strikes you as a great business. This is Walmart's 1980 annual report. It shows you these amazing numbers. Net sales, square footage, net income, and shareholders' equity. This is back in 1980, and the returns on equity on the business were already 30%. It had just reached the critical point of 1 billion revenues in 1980. Very interesting and fascinating company. This is Microsoft in 1985, around there, the IPO prospectus. I just read the IPO prospectus. Here you could see, it was profitable. It made about $24 million. Now, of course, it's very hard to forecast that Microsoft would become the second largest business at the time. But the point of this slide here is to show that it's starkly different from a vast majority of IPOs in the last few years of tech unprofitable businesses that have come about, which I've been writing publicly. That there was a massive bubble. So they're great businesses that were founded, that were making money on day one. And so you don't have to make your life difficult by investing in companies that might make some cash flow 5 years later. Of course, I'm presenting to you on a Microsoft PowerPoint. The tool has remained largely very similar. All my number crunching essentially is done on Excel. I've been using the same product for the last, 20 years. These are very predictable, high return businesses. This slide just shows you an excerpt from one of my data sets, which just shows that capital returns play a significant role. If a company has excess cash on its balance sheet, returning cash through buybacks and typically reducing share count is a smart thing to do. And that's where Apple has really distinguished itself amongst most of the big caps. Apple is engaged in massive cannibal-like share repurchases, which I believe, no doubt, was influenced by Mr. Buffett. Now, this is a topic that's very close to my heart. Valuation matters. Don't blindly overpay even for a great business. I'm a value investor. I'm willing to be patient. I think that part of that is kind of goes back to when I started as a private investor, which was at the peak of unfortunately, at the peak of the dot-com bubble. So I remember very vividly what was going on. And so this is Microsoft. If you purchased Microsoft at the peak of the dot-com bubble, you did not make money for 16 years. 16, right? I know we think about long-term investing, but that's a very, I don't know many fund managers that would wait for 16 years. And this is a good business, remember. It was already a $600 billion market cap, even though revenues of Microsoft grew from 22 billion to 91 billion, and free cash flow grew from 10 billion to 23 billion. So if someone told you that revenues were going to go up by 4.5 times, and the stock would do nothing, or lose money, you know, in terms of opportunity costs, you would probably not believe it. But so don't blindly overpay even for a good business. And we could discuss my thoughts on valuation. This is just a simple table. I think I posted this on LinkedIn. It just illustrates during the extreme bear market in China tech, which it still is very undemanding valuations. This is Alibaba versus Amazon, and it just showed the free cash generation of these two companies and how Amazon had an enterprise value of 8 times that of Alibaba, while Amazon has a net debt balance sheet, is no longer run by Jeff Bezos, engages in almost very little share repurchases, and its e-commerce business still doesn't make much money at all. This is just some charts which talks about FOMO, you know, which is fear of missing out. These are well-known names. Carvana, which is down 97%. I know a lot of smart investors got involved in this. C Limited, which was worth nearly 200 billion at some point, which defied, you know, all sorts of common sense. Tesla, you know, I leave it to you to sort of judge that, but down 70%, and there's Peloton. So again, you know, I could put 20 more charts like this, but the point is that valuation does matter, and fear of missing out is very hard to resist. The next slide is just about the lemming effect. You know, people sort of tend to move in herds, and investing requires an independent mindset. You should not outsource your own due diligence. You know, you need to understand the incentives of various stakeholders. The sell side has their own incentives. The buy side has their own incentives, which is asset raising, right? It is performance, but really asset raising drives that. So you need to understand incentives, and you know, I don't personally, I might have read 5 sell-side reports in my entire career. I don't read sell-side reports unless it's a great industry report, because I'm not sure like it's going to add, like I should be able to come up independently with my own estimate of what the business is worth. This is Carvana, which was, I've taken out the name of the bank, but essentially the price target was 420. It's now trading at $8. This is Silvergate Capital, which was a crypto-focused bank. The target was 158. It's trading at like $5, I think, $5 to $8. This is Snapchat. I think it's crazy to think that that was worth as much as it was. If you look at the cash flow statement, stock-based compensation is egregious. So don't outsource your own research, right? Here is just on valuation. Jeff Bezos talks about long-term orientation and focus on cash flows. I'm not going to go through the next 3 slides in detail, but you should read the 2014 annual report of Amazon, because it goes through this illustrative case study about a business which is growing earnings, but the focus should be on cash flow analysis, because you can easily grow earnings through leverage, by issuing shares, through acquisitions, or accounting shenanigans. There are many ways to inflate earnings. You should not focus really on accounting earnings. You should focus on sustainable cash flow. And this is an example from Amazon's excerpts, and Jeff Bezos understands fundamental analysis better than most Wall Street analysts. So just go through that. I've sent the slides as well, so you can look at the numbers yourself. I have also put together just a table, you know, this section on accounting shenanigans, which is near and dear to my heart. I believe part of great investing is avoiding, you know, well, especially concentrated positions on companies that can go down 80, 90%, because that's a career, that's a killer, right? So back when I started investing as a private investor back in 2000, Enron, stock had plummeted to about $1. I will admit that I actually bought Enron at about $1, thinking it can't go to zero. I think I was 19 years old or 20 years old at the time. It did go to zero, right? And I was clearly speculating. I didn't know much, but now I do. And so I wanted to share these lessons. Essentially, Enron was engaging in this unbelievable revenue recognition, which is mark-to-market accounting and grossing up sales on its trading business. Essentially, the company went from 9 billion in revenue in 1995 to 100 billion by 2000. Those are egregious numbers. I mean, even Tesla, I can't recollect Tesla's revenue. I think it's about 40 billion or maybe slightly higher. Coke, Nike is 45 billion. If you look at some of the greatest businesses, you'll struggle to get to 100 billion. But Enron's true revenue was probably 5 billion, but they were, it was inflated by at least 15 times. And they use special purpose vehicles as well in order to inflate operating cash flow through unconsolidated subsidiaries. There were a lot of red flags. I won't go through each of them. By the way, the auditor was also paid very high annual fees. I think I read somewhere tens of millions of dollars, which is highly unusual. And analysts were rating this strong buy with conservative DCF assumptions, right? So that lesson always stayed with me. Don't trust other people and just do my own work. And ever since, I have never followed, anyone's recommendations. I just do my own work. Satyam Computer, this company managed to fake even cash. The red flag there was fake interest income. You couldn't reconcile the interest income with the cash balances. They had significant related party transactions, which is a huge red flag for many companies I look for. And many companies in Asia have many significant related party transactions. And by the way, the board of directors had the who's who of the corporate world. So don't let that fool you. Sino-Forest, revenue recognition issues again, authorized intermediaries. I'm not going to comment on Olam because I think there was a report by Muddy Water. Again, I haven't done the work myself. Toshiba was ensnared in an accounting scandal. Again, this is just the culture of making numbers and limited opposition to senior management. There was this company called Hanergy Thin Film in China. At one point, the founder was the richest man in China. And there was, again, significant related party transactions, a small float, and the stock was cornered. And the last example is ABC Learning. I actually had a full deck just on case studies on this. If anyone's interested, you can email me and I'm happy to share that. But given the limited time that we have, I thought I'd just put it in table format. In summary, before the Q&A, I forgot to do an introduction of myself. My name is Sid Choraria. I focus on great businesses that endure crisis periods. If a business cannot survive and grow amidst crisis, it is not a great business. It's just that simple for me. So I look for crisis periods and I look for how companies have done in that time period. Now, there are younger companies I do invest in which don't have that type of data set. And we can talk during Q&A if you're interested as to how not all companies are equal. So I have a group of companies that I monitor and I categorize them in different categories because they are different growth stages. And so the data sets are different. But in general, what I do look for is, can this company really survive a crisis? Now, less than 0.5% of the 30,000, 40,000 world's listed companies meet that test. So call it 150 businesses. And even within that, they're not all the same, right? It requires a lot of focus work. I spent over 15,000 hours. I sort of work at least 6 days a week. I think Charlie Munger says you take a simple idea and take it seriously. You can't do this part-time, right? You may as well just invest in the index. I read filings. I try to read filings every day. You must love the process. The outcome is going to follow. If you don't love the process, you're not going to have fun. Mr. Market is going to humble you at some point. Purchase price really matters. I mean, this is where, you know, I'm a cheapskate. I don't like paying up. I feel 99% of investors lack the discipline to pay the right price. And I think this is what we can learn from Mr. Buffett. If you look at some of his uh, biggest wins, which are a lot of them, you know, he has never really, I mean, he has made he has made mistakes like all of us, but this is where he truly sticks to kind of, you know, I mean, he has a great business that is predictable, and then he doesn't overpay. So for any business, you have to ask yourself, how noble is this variable and how important is this? If it's not important, there's no point focusing on it. But if you can't predict 10 years from now if the company is going to exist, you may as well not even spend any time on it. It's kind of like building a relationship. The only reason I've sort of agreed, you know, Shinya, you know, I met him many years ago when I was in, you know, about 10 years ago. And you want to engage in relationships, you want to grow and nurture, and you can predict like 10, 20 years. You know, I have great respect for Shinya. So I said, yeah, I'd love to do this. And besides, I wish someone had told me what I'm telling you when I was 20 years old. I think you really want to know, you want to focus on can I predict this company's revenue with certainty 10 years from now? Like, for example, Google. I can't predict Google's revenues because it has 80% advertising revenues. How would I know how advertising is going to look like 10 years from now, right? But I think we can predict sort of what Wrigley chewing gum or Coca-Cola's revenues might be, at least what, you know, we don't think that's going to disappear. And so the point is that I think you need to ask that question. And most investors ignore this basic test. Again, own businesses, don't own stocks. Focusing on daily prices is not investing. Long-term orientation with anything in life beat short-term behavior, right? You want to think about investing long-term. You want to think about your health long-term. You want to think about your relationships long-term. If it doesn't matter in the long term, you shouldn't spend a lot of time in the short term. Wall Street prefers activity and asset raising. You have to understand the incentives of the various stakeholders. That explains outcomes. One of the most important things in investing is temperament. It's not where you went to school. It's not who's pitching a stock. It's not that Bill Ackman owns X, or it's not that Kathy Wood, you know, loves this stock. It doesn't matter. The only thing that matters is whether you're right and whether your facts are right and whether your temperament is right. I mean, just my professional background, because I skipped it, I've worked about 15 years, you know, I sort of worked both in the sell side and buy side. I spent stints at Merrill Lynch during the crisis. You know, I saw how poorly structured incentives could kill even an iconic American brand. And then I went to business school. I worked at Goldman, TMT, and then I worked in fund management. The last decade, primarily focused on Asia, but I do now have a global focus. I do think that great businesses are what I'm after, and they're not limited to China or India, which certainly has great businesses, but I think I'd be very hard pressed to find 15 great businesses at extraordinary prices. And moreover, I think what we learned from China in the last 2 years is that external risks can happen when you least expect it, and good luck to those that were only running a China fund during that time. And so I'm going to stop now and open it up to questions. I hope that was useful, and I'd be happy to take any questions.
Molly.
Yeah, sure. So, yeah, someone is raising the hand.
Yeah, please start with the questions, and I will ask the questions and we will open it up.
Sure. Yes, Sid. Let me introduce myself, Sid, first. So, myself, Mauraj, I'm from India. Okay, so I co-founded an artificial intelligence-based company in India. And if I could say in a word, like, where I can introduce myself, I can relate to your fourth point of the, summary, where I really enjoy myself as an investor. I enjoy the journey, not focusing on the outcome process. Right. So let me start with my first question. So I wanted to understand that how do you assess whether the moat is getting wider or narrower? Right, it's a difficult process to do it, right? Because you have to have this updated view of Bayesian thinking, right? Where you have to update your views regularly in order to understand whether the moat is getting wider or narrower. Yeah.
Yeah, I mean, there's no formula, right? But I think that for me, I sort of look for this: is it noble and is it important, right? Like as I told you, people thought Google's moat is incredible. Now I think it's a good business. Do I think it's a great business that I could predict 10 years from now? The answer is no, and I think that no one can predict that, right? There are some businesses that are more predictable. I think we can predict with some certainty what Kobayashi's revenue is going to be, or Coca-Cola, or Wrigley's chewing gum, or Hermes, or there are businesses that you can predict, and I think Mr. Buffett tries to stick to that. And I've sort of learned, look, investing is hard enough. You don't want to start. So I think with moats, you really have to assess. If the world went to hell, would I still want this product? And if the answer is yes, then the company has one hell of a moat, right? Apple has one hell of an ecosystem, which is kind of why it generates about $100 billion of cash flow. There's no right or wrong formula, Mauli. I just, I look for whether the company is going to be still very much required by customers. And customers love this product so much that if everything goes to hell, they still wouldn't part with that device or, that product.
Am I audible?
Yes.
Maybe you could, there's some echo, maybe you can, maybe you can try asking the question, otherwise type the question.
Yeah, so Muli internet is unstable. If he's not able to ask it, then I will ask
Sure, why don't you
my
go
question.
ahead? Yeah.
Sure. Okay, so my question is about accounting. We talked about cash flows, and I wonder whether, assuming management can use creative accounting, do we even need to master the IFRS or GAAP, in your opinion?
Well, management is always, as I said, understand incentives. I think that one of the eighth wonder of the world or the ninth wonder of the world is understanding people's incentives. So people are going to tell you what is in their best interest, and that's true for the fund management industry. That's true for companies. That's true. So accounting is the language of business. So you need to understand what the rules are, and if companies are engaging in creative ways to inflate their true profitability, their true returns, then I just skip it. Now there are, I've been writing on LinkedIn and publicly about adjusted EBITDA. Firstly, EBITDA is a very unreliable metric. But once you have adjusted EBITDA, and once you have adjusted revenue, and once you have adjusted gross profit, and once you have all these adjusted metrics, I stay clear of these companies. I almost never look at investing in these companies, right? I have walked out of meetings where the conversation started with adjusted, and I said, look, it's just, this is not going to work for me, so I just walk out. Because if it's too difficult, I think you need to spend your time looking for great businesses. My focus is cash flow analysis. It's harder to fake cash flow. In the case of Satyam, they faked the cash balance. It is very hard to still fake cash, at least in the United States, Japan perhaps. It's hard to fake cash flow, right? There are lots of checks and balances. And I think a student of investing needs to understand cash flow analysis. There's a very technical book called Creative Cash Flow. It's I think 600 pages. I've read it 1 or 2 times. It's quite a heavy read, but I would recommend you read that.
I'm currently reading it. It's great one.
Yeah, and I think that some of the red flags I look for. I presented some of that table with eight companies. Related party transactions. Once you see a lot of related party transactions, I typically skip the company. Like I have seen a lot of companies go to zero eventually, just with this one signal, right? Second is they're growing much faster than peers, and their product is not necessarily any much better. Like Satyam was growing or had margins that were you couldn't explain. I think that balance sheet, you got to focus on the balance sheet and focus on many of these obscure items like goodwill, tangible, intangibles, etc. And you want to understand how inventory is growing faster than sales or receivables. You want to get into some of the footnotes. Now, the longer the annual reports or the longer the filings, there tends to be problems with the company. If you look at Apple's annual report or you look at Berkshire, they are just as long as they need to be, right? If there's lots of disclaimers and audit opinions, etc., there's going to be issues. So I think as you gain more experience, what I would say is start with the cash flow statement, balance sheet. Watch out for related party transactions. Watch out for excessive growth through the use of, acquisitions. Watch out for companies that are engaging in serial acquisitions. Valiant was a case there. So you need to embrace accounting. The world is going to tell you what's in their best interest, but that's not a good excuse.
This meeting is being recorded.
Bunny, you have a question?
Yes. Thank you so much, Sid, for your presentation. I find it's really, really insightful for me. So a quick introduction for myself. I'm a Z Club alumni and I currently work for Fidelity in the past 3 to 4 years. I found your sharing a high resonance based on with my daily work when I do investment. So thank you very much. A few questions from me. So firstly, it seems you have a very, very high minimum quality bar, and all the examples are, most of them are based in US. So wondering for China, do you think there is any long-term winner here? And is there any process difference when you invest in companies based in China?
Yeah, I wanted to have like 100 pages with filing excerpts, but I knew that I was limited to 20 minutes for going through my slides. But I have a lot of filing excerpts I've read for Chinese companies with very similar things. And I should have included a Chinese company. Of course, Alibaba and Tencent are high up on that list. NetEase is also high up on that list. I've made public presentations in the past on companies like NetEase, Shanghai Airport, which, by the way, I was recently looking at, given China's opened up, Alibaba. By the way, these are not recommendations. I'm just saying what met my quality bar. I've publicly been discussing Alibaba's thesis. I was on CNBC just about a month ago because it was just extremely priced. And when I noted that Alibaba was engaging in significant share repurchases, a 15 billion repurchase program. Remember, Amazon in its history has not even come close to buying back 10. And it has my take there with China is that obviously China is a very tricky place to invest because you need to understand what the government, what the regulators want to do. You can't, it's married, it's sort of a two-legged, you have a three-legged stool, but in China, I think you need to have that, right? Which is not the case necessarily in the United States or even India or Japan. And I think my take was that it is not, my understanding of China, and I've been to China, probably about 20 times or so, and my understanding of China was that you cannot take away economic prosperity and freedom. You can take away freedom of speech, but you can't take away economic prosperity. And that's kind of what was happening. And my bet was that the leaders, the powers that be, would not continue to engage in that, because if I don't have my freedom of speech, I'm fine with that as long as I can make a lot of money, right? Which in the past people have made, right? Jack Ma, Pony Ma, etc. But the moment you take that away and sort of the lockdowns, etc., I thought were extremely harsh. And I believe that after the party Congress, that would change. And I'm being very surprised by how fast that's changed. but I think you need to understand incentive analysis. So I digressed with my answer. I think one of the better companies in China is NetEase in terms of shareholder, in terms of corporate governance, etc. Now, it is a gaming business. I'm not recommending the stock. And there are lots of great businesses in China. You know, Maltai is another company that I used
I
to
see.
own as a professional fund manager.
Mhm.
And, you know, I'm looking for the same things: high returns on equity, high growth, you know, product that doesn't necessarily have to change, share repurchases. Yeah.
I see. Oh, that's very helpful. If I can have another question is, do you care about market consensus and the difference from that when you do
No,
valuation
I
work?
know I don't pay. I'm sorry. I just like, I have to be very blunt here. I don't pay any attention to all that, right? Like I mean, I have a lot of smart friends all over the world. I don't listen to what they have to say about the value of Tesla or the value of C or the value of Caruana. It makes no difference to me.
Mm.
You know, what anyone thinks. I mean, it's common sense. You look at the balance sheet, you look at the cash flow statements, you look at the actions of management. Let's just take Tesla, for example, right?
Mm.
It's a very controversial stock. You know, let's just say you believe the cash flow numbers, right? It generates about $5 billion in free cash flow. Again, I haven't looked at the recent numbers, but then insiders were selling significantly. You know, Elon Musk has been selling shares, you know, all throughout. And if you look at all the buys versus all the sells, there's only sells through. So I focus a lot on actions. You know, don't pay attention to what people say. Focus on what they do, right? So when I see that sort of action in a widely overvalued business, which is a great product, by the way, which is
Mhm.
Tesla is, you know, Elon Musk has done some great things for the world. But when it comes to stocks, when it comes to valuing a business, you must be objective. You must be independent. I think Buffett has said, if you can't just sit alone in a room and read filings, and you can't succeed that way, nothing is going to make you succeed, right? So I may have read maybe 3 or 5 sell side reports in 20 years. I mean, it's just not a good use of time.
I see. So you only read company filings mostly.
I go straight to the company filing. I go straight to the balance sheet cash flow. I try to understand, is this product really important? Like, if the world goes to hell, what's this company going to look like? Now, many companies have lots of data sets. Did you know that Microsoft, for example, in 2008, bought back 13% of its shares outstanding, right? So we know exactly how the company was acting. Now, for younger companies, you have less data, but I go straight to the filings, and like, for example, on Kobayashi, before I sent Mr. Buffett the letter, I had read 20 years of the annual reports. And I had just said, okay, this is what they did. This is what they said. This is what they did. This is what they said. This is what they did. Because the beauty of history is you can't change it, right? You can just go back and just read everything. And I was like, by the end of it, when I reached 2013, I was like, this is an awesome company. Now, I didn't think it was going to go up 4x. I think that is partly driven by liquidity and easing conditions, etc. It's a good business with lackluster growth, but the multiple expansion has been significant. And but I knew that it met Mr. Buffett's test of sort of predictability, and so that's kind of what I read. I just look at filings, and what I do is I try to build a second brain. So I have a list of companies, and I have a second brain that I try to build, which is keeping track of interesting filing excerpts in my notes for every company that I read, right? Because what happens is, in this world, we are very distracted. There's Twitter, there's LinkedIn, there's a Zoom call, there's the sell-side report. And the less noise you have, the better it is. So like, even if I wanted to read sell-side reports and talk to all my friends to understand their views, I think I'll just run out of time. So the best thing I can do is just be really good at understanding cash flow statements and balance sheets, incentives, and I make mistakes all the time too, right? But I just don't think the mistake was wow, I wish I listened to Goldman Sachs or Morgan Stanley, or I wish I had paid attention to Kathy Wood's great presentation on whatever, right?
Yeah, luckily you didn't. So I'm asking this question mainly because I want to know how do you value a company and how do you predict, how do you make the judgment call whether it's overvalued or
Yeah, so I think the first thing is you need to know where the risk-free rates are, the cost of capital, right? So if I'm paid 5% to just keep cash in the bank right now, there's already I need to earn a lot more, which is let's call it 15% at least or 20%. I need the bar goes higher. When interest rates are zero, then you have all sorts of crazy behavior, which is exactly what happened. You had all sorts of crazy behavior, right? I don't need to go over the crazy behavior we witnessed the last year. So the first point is, what is the risk-free rate? And if I put my money in the bank, how much do I get? Okay, so that's kind of the hurdle, right? And then you need to understand a company is really, what is a company? A company is not a charitable institution. It is an organization whose job is to generate cash because cash pays the bills, right? You have employees, you have to pay your bills. And so I need to understand how much cash can this company generate in a crisis? How much cash can it generate in a normal situation? And it needs to be predictable. Predictable meaning, as I said, people thought Google's a great business. I think it's good business. I think they're going to do just fine because they have this war chest. But I cannot predict Google's revenues even 5 years from now, right? 80% of it is advertising. That means you have to have a view on the advertising model. So the three variables I look for are growth, like what sort of growth can this company have during a crisis? The returns on equity, unlevered equity, which is some of the slides I showed you. You saw Coke was about 30%. You saw Kobayashi was about 40%. You saw Nike's about 30–40%. And then you compare it to cost of capital, because really you're looking for the spread. And then I look for returns on equity, growth, and cash flow. And then you want to compare that as if you were buying 100% of the business. Let's say you took over Tesla. What is the cash flow that you would get to be able to deploy it into the business? Let's call it's 5 billion. What are you paying for that, right? You're paying, I haven't looked at the market cap of Tesla, but let's call it's $1 trillion. Then you have to say, is that the best deal I can find? And you have to compare it to the risk-free rate. Now, we could talk on and on about valuation, and this is probably a separate discussion, but I think I've given you some of the key variables I look for. It has to be a no-brainer, especially if you're going to have a very diversified portfolio, and I say over 40–50 stocks, you may as well own the index. You don't need an active manager, right? Because essentially what you're going to do is be funding the Hamptons house, right? If they have a very diversified portfolio. Now, if you run a concentrated portfolio, that's also dangerous, right? You don't want to have the same type of businesses in that concentrated portfolio. So if you only have the Teslas of the world and the C groups of the world and the Carvanas of the world, which are not generating that much cash relative to their market value, and if the Fed hikes, which it has, cost of capital, then these stocks will fall because, as you know, interest rates are gravity to valuations. So concentrated investing in very similar types of cash flow buckets is dangerous, right? But I think if you have a concentrated portfolio of businesses that are very different in different currencies, I think that, you know, you don't need more than 15 stocks. You don't need more than 15 stocks. So I focus globally because, you know, as we've seen risks in China last year. If you just ran a China, you know, my goal is to generate the highest IRR for myself and my investors. Currently, I don't have investors because I don't want them. But the point is that if you're trying to generate the highest IRR, you are looking to have the best business at the best price, and ideally for as long as possible.
Okay, I see. So in general, a conclusion is you generally use free cash flow or EV to free cash flow multiples like that to value.
I'm hesitant to give you like these multiples that you can read on us with them, because that's not how I think about it as a common sense. I said, so if I had to buy the entire, let's say Zoom is a market cap of about 20 billion, approximately. I haven't looked at it recently. The enterprise value is say 15 billion, right? Because it has 6 billion or so in cash. It generated approximately $2 billion in free cash. You know, if you strip off all the investments they're making. So here's a business that generates 2 billion with a 15 billion enterprise value, right? Now, that's today, but we need to be sure that that's what it's going to be 5 years from now. And some businesses is more predictable than others. Now, if you can assume that Zoom is going to stay flat cash flow, then you know that in 7.5 years, you would get your money back, right? But it's of course more difficult than that because you have to predict where cash flow is going to go. So I don't think a multiple or a past multiple is the right way to look at a business. I think there are some of the things that I talked about, returns on equity, growth, cash flow, predictably. Yeah.
Thank you very much. Thank you, Sid. I saw Jeffrey also have questions. So very quick last one from me. So I know every process has its pros and cons, and it's underperform and outperform in different periods. So wondering for your process, which has very high minimum quality bar and focus on great business. So wondering what kind of pitfalls that this process generally fall into in your past experience, and how to avoid that.
Sorry, I think I missed the question. Could you rephrase it in a shorter way?
Yeah. So wondering for your process, in what kind of period will it outperform, and in what period will it underperform? And in terms of pitfalls, what kind of pitfalls or mistakes does it generally encounter?
Well, you know, at the end of the day, it depends what your time frame is. If you're looking at annual or quarterly performance, there is no strategy that can guarantee you any sort of predictability, right? When I think about anything in life or investing or health, it's a very long-term outlook, right? It's gonna make no difference to me if the strategy or if what I do underperforms, you know, a year. Now, of course, if there are mistakes, then that needs to be corrected. But the idea is that if you invest in great businesses that are earning high rates of returns and are able to deploy that into predictable growth, you are going to mimic what the returns on equity of the business are very long term, as long as you don't overpay. There are very few investors that have compounded at 20% plus. So if you could be very disciplined on the price that you pay, in the long run, you're gonna do just great. But I can't predict with any certainty whether in a particular quarter.
To define long run, is that 3 to 5 years or 5 or 10 years horizon? So
Well, let me ask you a question. When you think about buying a house, when you think about a partner, how long run is long run?
Lifetime.
So shouldn't you think about investing in the same way? Why is investing any different?
I think it depends on our clients. If the clients cannot withstand more than 3 years underperformance, or employer cannot understand, then it will be.
I'm sorry, I can't help you with that, because you need to.
Yeah.
I think the answer here is that you can't maximize performance in a quarter or a thing. Last year, you needed to understand that Occidental Petroleum or energy was a great place to invest, right? And energy was an outperformer. Now, it was also a great business. It was delevering, cash flow was growing, and it was important. So there is no one formula or strategy that is going to guarantee our performance in any given quarter or any given year. But the strategy that makes the most sense to me is investing in the highest quality businesses over at good prices. And I think over a 3 to 5 year horizon, it's going to be very hard to really do poorly if you do that. If you do that well, the challenge is it's hard to do it well.
I see. Okay, I see. Thank you so much. In the interest of time, I'll hand over to Jeffrey. And thank you very much, Sid, for your very insightful sharing.
No worries.
Hi, Sid. Thank you for sharing your insightful investing journey with us. My name is Jeffrey. I'm a Z Club alumni as well. Currently, I work in the private banking industry. So my question to you is, I have two questions. So first of all, you shared about Nike earlier. I just want to understand, what is your approach to evaluate companies that may be building great brands, but then sometimes it could be difficult to define their moat or their competitive edge. So something like Nike in their earlier years, right? The second question is, besides Warren Buffett, which other investor do you admire and follow? Thanks.
Yeah, I think on the first really is that I think I've sent my slides to Maoli and the group, right? I think you should go back and study every single annual report that I mentioned and just pick it up, right? Because it wouldn't do justice by just looking at one of the excerpts. But I think brand is a good thing, but I think it can be overrated as well. Like Lenovo, I'm using a Lenovo computer right now. Lenovo has a brand. Is it a great business? I'll let you decide, but I don't think it would meet a very high. I mean, it's a good business, but it's not an exceptional business, right? A brand is when a great business is one that can endure even a crisis. So even if something, if the world goes to hell, consumers still need that business. So for example, like Microsoft, right? How many of you use Excel? Can I assume every one of you uses Excel? Yeah. Well, I've been using it for 20 years, right? Now, is it a coincidence? I mean, can I do without it? I don't think I can. What is the alternative? I mean, I could use my, I have these large data sets. Now I could do without Zoom. We could use Teams, we could use Google Meets, we could use other products. The same thing with the same type of analysis was done by Warren Buffett when he thought about Amex and Coke during, Amex particularly in its crisis. So in terms of a brand, I would say don't get attached just from a brand image, because there are plenty of companies with brands that are not good businesses. You look for the high returns on equity. I think what Nike did, which was very great, they had a good product, but come on, it's a shoe business, it's a shoe company. We can, I'm sure someone else can make a good shoe company, right? Just like Starbucks, right? It's a coffee company. Is the coffee the best? I don't know. I've had better coffee in Singapore at some of these local coffee shops, right? Starbucks is not a coffee company. It is a place where people come to meet and hang out, and there's a much bigger, there's a bigger element to it, right? So I think that the business, they've obviously done a fantastic job growing it from like one store to thousands of stores, and like I don't know how many hundreds of thousands in China alone. So I think that a company, what I'm saying is a company can have a brand, but it doesn't mean it's a good business. A good business has high returns on equity, high returns on invested capital. It has consumers that love it, and there is no other choice. Like at the time Buffett bought Amex, that was the case. It is the case for Coke, at least it was very much so the case 30, 40 years ago. And I think that Steve Jobs, there's a YouTube video about Steve Jobs talking about Nike. I don't know how many of you have listened to it, but he talks about how Nike has got this amazing marketing strategy. Because when you think of Nike, you don't think of a shoe company, you think of how they honor great athletes. And so I think the mind share of customers, if it is so deeply ingrained in that product, I think that's great business. But I can't just give you a checklist and say this is kind of what you need, because you need to ask yourself the question: can this business survive during a crisis period? How badly do customers really want it, right? Like Alibaba, my simple thesis was, look, there's like I'm not in China and I'm not Chinese, but I have plenty of Chinese friends and they shop in Alibaba or Pinduoduo pretty much every day. And if that shut down, how would they go about the day-to-day lives? Like, I'm not sure I had an answer to that. So I think that you have to ask yourself, and that's why investing is very interesting, but you have to ask yourself how necessary is this? You had a second question. I think in terms of investors, look, I'm a self-taught investor. I learned everything myself. I wish I had an amazing mentor. I have worked for multi-billion-dollar investment firms, but I would say I learned everything myself. I sort of just was very curious. I read a lot. I read everything I could, like especially when I was in my mid-20s. I've read the Berkshire letters like 7 times. I just scribbled on it. I read everything Michael Burry had written and made notes. I read the McKinsey book like 6 times. I just read and read and read. And then I've sort of made it, I've sort of come to my own conclusions about what I think makes sense from a common sense perspective. So there are not that many great investors I admire, and I'm not trying to sound, arrogant or anything. It's just that I'm self-taught, and I think that investing is a journey that you kind of have to like go through the process. And I think with any field, you want to follow the very best. Why would you want to follow the second best? And the best is clearly way ahead of anyone else. He's been doing this for 50 years, and all his letters are publicly available. Very few people have taken the time to actually read every single letter and understand every single word. I think if you do that, you are like in the top 0.1% already, right? So I would just say, if it's tennis, you want to follow Roger Federer. If it's boxing, you want to follow Muhammad Ali. If it's investing, you know who to follow, right?
All right, thank you.
There are some great investors in China. For example, Li Lu is someone I tremendously admire, but unfortunately, his letters are not public. But I have a sense as to kind of how his thought process is. He's exceptional. He is very disciplined on the price. He's got a great long-term orientation. You want to read as much about Amazon's letters. I think Terry Smith in the UK, Fundsmith, is great. Nomad Nick Sleep was amazing, but again, he had a few concentrated bets with Costco and Amazon, etc. And I'm not sure one can replicate that, but there is a lot of learning to be said. These are some great investors that you need to read up on, but I think that ultimately your process has to be something that you believe in. And I think that I started my journey from a cigar butt perspective as well, small cap companies, and as I learned more, I realized that the best way to invest was really focusing on the best businesses, because it's not just compounding capital, it's compounding knowledge. It's developing relationships with the CEO. Like Zoom was a business that I was following, and I actually wrote to Eric Wan, and he actually responded to me and was like, well, this is very interesting. You actually get to engage with entrepreneurs that are doing some really interesting things, rather than focusing on a cigar butt where there's a business that you're not going to learn that much. So my own journey took me to these great businesses.
Sounds good. Thank you for your response.
Muli?
Any final questions?
Yes, Sid, am I audible? Are you
Yes,
able to hear me?
Yes.
Perfect. Sid, you mentioned about, buying a business which has a certain cash flow, right? You mentioned about chewing gum, Coke business. But see, nowadays markets are fairly efficient. I cannot say it's completely efficient. It's fairly efficient. Buffett bought these businesses during the 80s and 90s, so he was able to, make those tremendous return, buying a great business at a good valuation. But I feel that nowadays that the market has reflected fair value on this great business, which has a certain cash flow statement for chewing gum businesses. So, and also Monish Fabrai emphasized about investing in business which has an uncertain element, right? So my question is that if the predictable business has reflected its price value in its business, so how are you going to earn the superior returns?
I gave you you just have to, as I said, these were filing excerpts where I wanted to highlight the ingredients for a great business. Because the first thing is you need to know where to look. Because if you're looking at the wrong place, then you're not gonna understand the philosophy. So you need to know that a great business has certain characteristics, and I wanted to illustrate that. As I said, Kobayashi was trading at like 6 times my estimate of cash flow at the time. It was a 125-year-old business. No Japanese analyst was really covering it. There was one analyst that wrote one page, and the stock has performed the S&P. Now, there are lots of these smaller mid-cap companies that might be out of the radar. Now, I'm not sure the market is anymore that efficient. I think it has gotten more efficient than the 1960s or 70s, right, when information was not as widely available. But I would argue that the markets have also become more short-term oriented now, which leads to mispricing, both on the overvaluation and undervaluation. For example, I mentioned C Group was worth $200 billion, or Tesla was worth, whatever it was worth. Is that efficient? I'm not so sure. Looking at the cash flow statements, I'm not so sure that that was what the business was worth, right? So look down the market cap spectrum. Focus on companies that are below 5 billion. So focus on companies that are below 2 billion, right? Especially if you're a private investor. It depends. If you run a very large fund, then your market cap thresholds, Mr. Buffett has got a very different problem, right? Like, because his size is his biggest enemy. But you don't have that problem. I don't have that problem. And so we can go down to smaller businesses. Now, the key is, as I said, Walmart, Nike, they all started as small business. Nike had 2 million revenues. Walmart had 21 million revenues, and then it grew to $1 billion in 1980. But even at that time, if you all bought Walmart, you would have made a lot of money. Even at that time, you bought Costco in 2000, or Nike, or many of these businesses that exhibited that, right? Products that don't change, you would have made money. You would have made money, right? So now, of course, that's hindsight bias, and I recognize that. The purpose of the slides was to illustrate the qualities of a good business. So Alibaba, I would say, is a classic example. I made the decision that is my largest holding. I made the decision that it was dramatically undervalued, and I believe that it was not in China's incentives to crack down on these companies anymore. They had already, got rid of Jack Ma. They had, done, as I said before, you can't take away freedom and economic prosperity. So that was my simple thesis, that at the end of the day, if they want to retain power, they can't continue along this path. And that's exactly what has happened with the opening. People are surprised, but why should they be surprised? What are you going to do? You're going to lock down 1 billion people for 5 years? How are you going to retain power? So these businesses were dramatically undervalued, and Alibaba was repurchasing shares. They repurchased, I think, $2 billion, and that showed to me that they believe in their own company. So great businesses tend not to be undervalued, but there are moments when they become dramatically undervalued, and you really have to act then. And that's where the sure concentrated bets are. Like Amex, right? There was the salad oil crisis. It was a great business. Salad oil crisis, it dropped 50%. And that's when Mr. Buffett estimated that this was opportunity to buy a great business with temporary trouble.
Okay. Yeah. That sounds perfect.
Maybe
Yeah.
maybe one last question or one or two last questions.
Yes.
Yes.
Sid?
Firstly, I haven't introduced myself. So I am Ophir, based in Israel. I am actually self-studying finance, the same as I was doing lots of other industries. I am also a self-taught software engineer and self-taught about logistics. And I'm now starting my own business in logistics. So
Great.
my question is about growth. You mentioned a big fish in a small pond strategy. So assuming that the fish takes 50% of the market share, what are some general guidelines we can use to measure how likely the next bonds of the company which is targeting is likely to succeed?
Well, you have to watch. I think with Kobayashi, what's unique is that they have this idea culture, as I said. So once they get this 50-60% market share, they're always innovating, having these monthly idea meetings where young employees can come and pitch a new idea. And if their idea is, if management likes it, they go straight into it. So they have a high new product conversion rate. I think in the annual report, they say it's about 25% or so in terms of kind of the, there are some metrics that they have in terms of new product launches, right? From these idea meetings, they get about 30-40,000 ideas a year. And so there's this amazing culture which empowers employees. And I think you just want to monitor the new product launches. You want to monitor how they're getting their ideas. And I think, like, if you go to Japan, like, just go to these drugstores and look at Kobayashi products. They're really niche products where other people don't really exist, or if they exist, they come in much later when the growth opportunity doesn't exist. And Kobayashi's already moved on, right? The beauty for that company was that they had virtually not sold their products to India or Japan or China or Southeast Asia. And so those same products that are loved in Japan should be loved overseas. And that was my very simple thesis as well. Not only are they great at coming up with these new products, but they haven't yet tapped the 3-4 billion plus consumer pool in Asia, and the Chinese love their products. So I think it differs from company to company. I think you're looking for unit growth. I think with Coke, it was 524 million servings. Buffett made the simple assessment that it should grow. And I think now it's about 2 million servings. I think you're looking for price increases. As I said, Costco keeps very low prices. They have not changed the price of the hot dog. You're looking for those two variables, and then you're looking for new product ideas, new markets, etc. Especially if you're selling in a country which is very small, like Singapore, for example, right? How many big Singapore companies do you know? They aren't that many. They have to go overseas, and so that requires a completely different skill set. So there is, I hesitate to give you a checklist and say, do this EV to FCF, or this is kind of how to look at growth, but this is how, because investing is a lot more nuanced than a checklist. But I hope I've given you some examples. What I would encourage you to do is look at all those filings, all these great businesses, and just read the annual reports for 20 years for Nike. Just collect the top 50, right? And just read their journey, and look at companies that have failed as well. Look at many of these Japanese companies that were some of the largest businesses in the world and have not gone somewhere, and just understand what happened there. And then you'll start to form a pattern recognition of kind of, the reinvestment opportunity. The reinvestment opportunity is very, very, very important. If a company is not able to grow, it's unlikely you're going to make a lot of money, right? So I think with Alibaba, they've grown from 200 million users or so to about 1 billion. Now they're going overseas. But there's plenty of other levers. They have new products, cloud computing. They have levers in the price they can charge. There's many cross-selling opportunities once you have that sort of thing. So there's no clear answer I can give you, Ofer, that you must look for this or that, right? It differs from company, country.
Okay, thank you very much.
All right. I think that we have all learned a lot from Sid tonight. And thank you so much once again for your time. We have learned so much and asked so many questions as well. So thank you for your generous sharing. And I think that comes to the end of our session today. Sid, do you have anything else you want to share? Yeah.
No, I would just say thank you all for having me. I wish I did this presentation because Shinya invited me, and I wish that when I was 20 years old, someone had told me the things that I have told you. So, I mean, just follow your heart, just dig deep into the filings, be independent, and love the process. Don't focus too much on the quarterly outcome and the annual outcome, and have fun. Feel free to follow me on LinkedIn. I tend to write publicly there because I like educating and I like sharing my views. And stay in touch. I wish you all the very best.
Thank you so much.
Thank you so much. Thank
Thank
you. Good night.